I would like to thank our sponsor of today's episode, Miller Cooper. Founded in 1919, Miller Cooper is the 11th largest accounting and consulting firm in the Chicago area. They have 335 professional staff serving middle market businesses and their owners. On a personal note, I've had the opportunity to do several transactions with the folks at Miller Cooper, and in particular, Tad Render, who leads the firm's transaction advisory services group. And they are top-notch. In every transaction, they really pull their weight in more than one way, and our clients couldn't have been more satisfied with the work that they did. So I appreciate them sponsoring this episode, and if you have the need at any time for M&A accounting and advisory services, I really highly recommend the folks at Miller Cooper. Hope you enjoyed today's episode.
Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Dominic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Dominic Rinaldi.
Are you a business owner that has always wondered if your business would be attractive to a private equity buyer? Do you know what to expect from private equity buyers? Well, M&A Unplugged community, you are in for a real treat today. We have Lamar Stanley with us, who is the Vice President and Head of Deal Origination at GenCap America. GenCap America is a private equity firm headquartered in Nashville, Tennessee, and they specialize in the acquisition and recapitalization of middle market businesses with 2 to 10 million in EBITDA. Lamar, welcome to M&A Unplugged, and look forward to diving into the world of private equity with you today.
Great. Thanks for having me.
So, Lamar, let's start with, could you give everybody a quick backgrounder on yourself?
Sure. Yeah. So I joined GenCap America 3.5 years ago. And previous to that, I was with a wealth management firm that had a private equity fund-to-fund strategy where I was making investments into GPs all around the country. And that's how I first got connected with GenCap. And prior to that, I was actually in business school. And the reason I had to go to business school is my career up until that point was completely in the military. So I had to go learn how to add and subtract before getting a real job.
Wow, this must be a real change.
Yeah, it's a different spot than the previous life, but pretty happy to be with GenCap. I'm also in Nashville.
Well, hey, first, I want to thank you for your service. I didn't know that you were a veteran, but thank you very much. And I'm doubly pleased to have you on.
Oh, thank you. It's my pleasure, but I appreciate you saying that.
So for the audience out there, talk a little bit about GenCap, their history, how they got started, their focus. And, we're going to dive into, not all private equity groups were created equal, all have their different strategies and criteria. So we'll get there, but let's talk a little bit about GenCap.
Sure. So GenCap is actually older by private equity standards. We've actually been around since the late 80s. So we've been doing this for over 30 years now. And specifically, GenCap now is on Fund 7, although that is somewhat of a misnomer. This is our third institutional fund. Some of the early funds at GenCap were mostly friends and family in and around Nashville. But GenCap, since the very early days, has been remarkably consistent in what we do. Specifically, what we're doing is we're targeting companies with 2 to 10 million EBITDA in earnings and for investment, and we make control-only investments. And the industries where we focus are manufacturing, distribution, and basic service companies, but we're actually much more industry agnostic than that. And the reason is because what we are actually looking for are qualities inside the company, specifically around the management team. In our typical deal, what we are looking for is a situation where an owner wants to retire or at least step back considerably. And there is a management team inside the company who we can back, who we give a sweetheart deal on equity, and then they run the company during our investment period, largely without as much relatively interference from us. Where a lot of private equity firms are touting their operational expertise and how they'll parachute in operators to come help and assist. We are actually offering the opposite. We're not going to fire off employees. We're actually going to stick with the management team and give them a sweetheart deal in equity, and then they get to run the company going forward. And owners really like that typically because, one, they get to retire without having to stick around the 3 to 5 years a lot of firms typically want them to. But also they get to know that their management teams who have helped them out all along the way are going to be taken care of and have a good shot at really making good on a sweetheart deal in equity.
Yeah, and that's, very different than a lot of other private equity groups, although there are others out there that have this main strategy, the fact that you're looking for good management teams, looking to keep everything intact is definitely somewhat of a different strategy than others. Let's go back. Let's peel back the onion a little bit though for our audience. You mentioned being on your third institutional round. Let's talk a little bit about how you approach fundraising and getting a fund together and what that means for the folks out there that maybe don't quite know how private equity groups go about doing that.
So obviously GenCap has made a transition over the years. In the early days where GenCap started was actually through our founder, Barney Bird, raised money in and around Nashville through friends and family. So a lot of individuals, high net worth individuals, making investments in him to go out and buy small companies. Where we really shifted in terms of what our fundraise looked like was with Fund 5. And in Fund 5, GenCap started to exclusively go out and target institutional investors. So pension funds and endowments and those types. And, there's good and bad to both. Individual investors, obviously, you can do it the small bite-sized way and fill up a fund with lots of individuals. Or for us, it makes fundraising a little bit easier when you go to these bigger institutions that can write bigger checks and have a little bit more standardized process for making a decision on whether or not they will invest.
And assuming your funds are committed funds, correct?
They are, yes. All of them are. This most recent fund is a Fund 7 is a $250 million fund that we raised back in 2016. So, yes.
And how far along are you into that fund? Like, how long will it take you to go through Fund 7?
Yeah, so our investment period is 6 years. I know some funds do a little bit shorter, maybe 4 or 5. And the reason for our 6-month investment window is because it's a $250 million fund and our bite sizes are investments in companies 2 to 10 million of EBITDA. That's a lot of smaller investments relative to the size of the fund. So we need a little bit more time to do it. And we're roughly halfway there now, which is about where we need to be in terms of on glide slope, but still a lot of work to do in a pretty competitive market. So no rest for the weary.
Yeah, it is a very competitive market. We're going to probably get there in just a little bit. I want to ask you some questions about that. But sticking with GenCap, so you've got the criteria of 2 to 10 million of EBITDA. You've talked about the fact that you want management teams that are willing to stick around, which gives you continuity. But when you're looking at deals, what other things are important to you as a private equity buyer that you're looking at that at a high level will tell you whether or not you're even willing to take the next step to a management meeting potentially or to look at further documentation?
Yeah, so really there are 3 things that are going to get a company through our first wicket, and our model is relatively simple, and that's the way we like to keep it, frankly, but just because it's been working for so long. But those things are, 1, stability. We like stable, predictable cash flows, and I realize we are not unique in that situation, but we are somewhat unique from other private equity firms in that we prefer stability over rapid growth. And what I mean by that is if a company is just really a rocket ship doubling every year in terms of revenue and cash flow, that's not a great fit for us, just because that growth looks a lot like volatility to us. And so for that reason, it's just not going to be a fit. Our preference is flat to that type of growth. Obviously, a little bit of growth is a great thing for us as well, but it can't be overwhelming. And the second thing that we're looking for is the management team, as I've mentioned. There are a lot of businesses out there that have an owner who is the secret sauce, and unfortunately, those are not great fits for us, since we are not the group that's going to be able to parachute in the operators and replace the owner. Kind of going to our focus on stability, we like to back a team that's been inside the company for some time. Preferably that team is the guys or gals that were sweeping the shop floor 20 years ago and they've worked their way up to be the key lieutenant to the boss, or maybe a child of the boss, a son or daughter. But that's another critical piece. And then the third piece is really what they don't have, and that, or I guess we would characterize it as downside protection. So customer concentration is a big gotcha for us, or I shouldn't say a gotcha, but it's something that we really can't bend on too often. If they're in an industry that's very cyclical, that doesn't work great for us. Or if there are some unfavorable industry trends, if you're selling buggy whips, that's not something we're going to jump into, just because we don't have the operational expertise to fight against those types of headwinds.
So in deals where management teams want to stick around and maybe the owner even wants to stick around, what typically happens in those deals? Are you creating a new executive structure for that company? And do you create a board of directors, and do you take a position on the board? How does GenCap approach those?
Sure. So it's not an issue if the owner does want to stick around. We have plenty of examples of that. We currently have 19 portfolio companies, and I think, doing the math in my head, but 4 or 5 of them, the old owner is still in the business, either in the business every day or at least just a chairman of the board, which we're always happy to have that corporate knowledge hanging around. But in terms of structuring the C-suite after our transactions, what's important for us is just that the next rung of leadership is identified. And what I mean by that is, in many cases, the owner wants to continue to be the CEO, and that's fine with us. But in the event that they get hit by the proverbial bus, we just need to know that there is a fallback option. He has or she has that GM or plant manager or head of sales that could take over in the event that person said, you know what, I have I've received a big check for this company. I think I'm tired of working, and so I'd like to hand the baton. In the end, we are transition capital. We're the guys who are trying to keep these successful businesses successful without much disruption.
Yeah, Lamar, you just hit on something that we talk about a lot with our clients, and it's come up a ton on the M&A Unplugged podcast. And so for our audience out there, Lamar's talking about infrastructure. And if you're the owner of a business and you are the key person in any function or any phase, you really need to think about limiting yourself in that capacity and bringing in additional resources, or delegating some of those so that you're not a bottleneck. It will probably make your life a lot easier, and at the end of the day, increase the value and marketability of your business.
No question.
So are there any other things that you look at in a deal, once you start to get into a deal, or you look at it and say, boy, that is just a non-starter. Like there's no way, we could get past this.
Sure. Yeah, there are a few, actually. The biggest one that we run into a lot revolves around customer concentration. I won't say that our hard line is at 20% customer concentration, but we certainly start taking a hard look at what the makeup of the customer base is at that point. Our hard red line is probably around 30% customer concentration, and I mean that in terms of revenue. But not all customers are the same. Yes, if Walmart represents 25% of your business, and you're in a consumer industry, let's say, that's going to be really tough. But we all know there are businesses where there is some customer concentration, up to 30% in some of our businesses, but there's a good explanation for either why that customer really needs our company or why the relationship is particularly sticky that helps us get over that hurdle. But past 30%, and it's just really tough for us. And frankly, we look at over 1,000 deals every year, and we'll only do 3 to 5. And so time is critically important for us. And so consequently, we're not going to waste other people's time digging in on something when we see an issue like that. It's just not the best use of everyone's time.
Yeah, look, you just gave the audience another key message, right? And you're not, GenCap's not alone in this, right? You're looking at 1,000 deals a year, and maybe you'll do 2 to 3. So for the business owners out there that are listening today, it's so important that your business stand out and that all of the key value drivers really be put in the best light before you go to market. And, Lamar's talking about a critical one here, which is client concentration. So, Lamar, let's talk about, so you see 1,000 deals and I'm sure you go down the path with a bunch of those. You get to LOI stage and you get something agreed to with an owner. What's your approach? What's GenCap's approach as a private equity group to diligence? How do you conduct that? And really what I'm asking is, as an education for the business owners out there, what to expect when a group like yours comes in to due diligence.
So we are going to hire a Q of E firm to help us with the diligence. And so they should expect, at a minimum, phone calls from this group.
And Lamar, can you stop for just 1 second and just describe Q of E? Make sure everybody understands what that is.
Yep. Q of E is a quality of earnings. And so effectively what we're doing is we're hiring a CPA firm to go in and vouch for the numbers. So point to that, yes, the earnings metrics that we have been provided look like those are what the business is actually producing, which to us is the most important part. We are going to be a little bit lighter as a firm on the industry diligence. The most important parts for us is the cash flow that the company is reporting. Is that what's actually been happening historically? And then 2 revolves around that management team. And while we don't push owners to allow us access to the management teams that we're going to back, just because a lot of these transactions can be somewhat sensitive up until the later stages, we do at least want to have some hard conversations with the owner to confirm that the management team that we are backing are in fact capable of running the company. Frankly, it's not a huge issue that we've run into too, I should say, in the past, because a lot of times these owners are not interested in setting their management teams up for failure. They will typically be pretty candid with us in terms of, can the management team that works underneath them, can they run the business or not?
And I'm assuming that while that Q of E work is going on, you're parallel processing your lending and debt facilities. Is that a correct assumption?
That's correct. Yep. So thankfully, 30 years of doing this has earned us some pretty great relationships with banks, both here locally in Nashville, as well as other places in the country. And we are relatively light in terms of the debt that we use in buying these companies. We are going to use senior term loan from a big bank, and we are probably going to finance roughly half of the transaction from that group, and then some portion is going to be financed out of our fund, and then we're going to try to whittle down the amount of common shares of equity in the transaction that will be smaller, just so we can give the management team that we are backing a larger portion to participate in.
Understood. And so, Lamar, and if you're uncomfortable giving me, actual numbers, can you talk maybe about your methodology to, every private equity group has their return on investment parameters, right? The numbers that they're trying to hit. How does your group approach general returns on your investments?
Yeah. So I don't love giving out numbers, just because a lot of our LPs have warned us against doing that.
Understood completely.
Yeah, no, but I do appreciate that it's an interesting topic. And what I will tell people is that the stability focus and downside protection focus of our diligence extends across everything that we do here at GenCap. And so while we, like every other private equity fund, love to show great returns, and we are happy to report that we are top quartile fund, we also are extremely focused on ensuring that we maintain our record as a fund that has never lost money on a deal. And so, we are not the fund that is going to have these just nuclear grand slam investments, but that has a lot to do with the fact that we are investing in companies that tend to be a little bit more mature, a little bit more stable, but we are also the firm that doesn't have the just total wipeouts. So the way that I describe our fund and the way that we look at our returns is the low beta model. We are trying to keep the volatility at a minimum and just, keep cranking out singles and doubles.
Yeah, makes total sense. So you mentioned and referenced a couple of times that you like to have the management and maybe even the previous owner retain some portion of the company. Is there a benchmark that you typically look for, or do you see, is there a pretty narrow range there, or is it all over the map?
It is all over the map, and the reason for that is because, and so also I should first make sure I'm clarifying appropriately, the ownership that we buy the company from, those guys typically leave without any ownership. We're trying to do a 100% buyout if that's what they would prefer. The folks who will wind up with a chunk of equity is the management team that sits just beneath the primary owner post transaction. So those groups, land somewhere typically between, well, frankly, they can land anywhere between 10 and 49% ownership of the company. More often than not, it's right around that 25 or 30% ownership. And what decides that portion is, one, their appetite for buying in. We do ask that the management teams that we back do kick in some money. It doesn't have to be, a ton. It just needs to be a meaningful amount to them. Just we want to feel like they have skin in the game, and we're happy to finance them for some portion of their investment. So their appetite for equity will decide some portion of how much they have, but also what's also deciding it is how much equity they had before we showed up. If there's a manager who already had 10% of the business, he or she will probably have more post transaction, whereas someone who had none before we showed up, they'll have a little bit lighter equity stake.
Great. Yeah, makes total sense. So you're looking at 1,000 deals a year. Let's talk about the market a little bit. What are you seeing in the market? What do you like that you see? What concerns you? Really interested to get your overall perspective, seeing that you're looking at so many deals.
Yeah, not much concerns me other than the pricing. So we have tracked, and we did a little research here recently looking at our deals over Fund 5, 6, and 7, and we've just seen the processes where we're able to win. The numbers, the ones where we haven't won, it appears that the numbers have steadily increased in terms of what the purchase prices have been. In terms of the deal flow, though, that's probably the most remarkable change in recent times, particularly in the August and September timeframe of this year. We saw a real spike in terms of deal flow. And typically, just to give you a little bit of historical significance of that, typically August has been a light month for us in terms of seeing deals. A lot of investment bankers that are going to kick off processes, we've seen them hold back deals until after the Labor Day holiday. Well, that did not happen. I don't have a great explanation for it, but in August and September, there was a 25% increase in the number of deals that we've seen per month. So,
wow, that's meaningful.
Yeah, it is. And I'm always hesitant to provide much data just because we see what we see, and it's hard to tell what's statistically significant. But that was definitely a statistically significant spike. And I think some of that through conversations with business owners and investment banks, I think some of that relates to coming into an election year. I feel like a lot of owners are just anxious to get out there before, uncertainty starts to strike in the market. But, we've been saying for a long time, there are a lot of baby boomers out there with businesses that they're going to want to exit soon. So maybe we're seeing that happen soon.
And are you seeing more deals in one sector than another? Any sort of trends along those lines that you're seeing?
I don't have the data to support this, so I'm only speaking anecdotally now. But one where I feel like we've seen a lot of aerospace and defense deals coming. And particularly when I've talked to intermediaries about that, they tend to be the industries where, an election has the biggest impact in terms of their marketability. So that there could be some explanation there in terms of them just wanting to get to market before they're impacted by uncertainty around political elections.
Interesting. We were involved this year in 2 aerospace transactions, and I know of a third pretty significant one that traded. So it's interesting you should say that. We did see an uptick in that sector ourselves. How about baby boomers? We've all been talking about the baby boomers for years. We had expected that wave to hit back, probably in the 2010 timeframe, but the recession, really sort of delayed that. Are you seeing more baby boomers starting to come to market with their businesses?
I, I think we are. I don't have the data to support that either, but I do feel like there's a large contingent of business owners that probably would have liked to exit, call it 5 or 6 years, or maybe 10 years ago, I guess. And unfortunately, 2009, 2010 happened, and it pushed out their exit date a little bit, just because the business wasn't where they wanted it to be at an exit, and so they've ridden this part of the cycle all the way up, and I'm not predicting that it's going to turn down anytime soon. I mean, frankly, we've been saying that we expected a slight drawback for 3 years now, so we're not much at predicting. But a lot of those owners that survived 2008, 2009, 2010, they're probably looking at their businesses now. It's stronger than ever, and they recognize that if the downturn does come, they don't want to be caught on the wrong side of it. So I feel like we're seeing more of those baby boomers coming to market now, but we've certainly bought businesses from all types here of recent. So it's hard to say.
I think I would say that we feel the same way, that we're starting to sense that folks don't want to get caught up in another downturn, and the market's been very hot. It's really sort of a seller's market, and it's starting to get some people to take notice and maybe get their businesses out there. So Lamar, in bringing this to a head and capping off the interview, and I really appreciate all the information that you've shared with the audience today, what advice would you offer to business owners who are thinking that maybe a private equity buyer is the right buyer? What would you say to those owners if you had a room full of them?
Well, I would say, one, don't try and time the market, just because, as we mentioned, you can probably get caught on the wrong side of a downturn. Two, and this is related to that, you're selling your business based on the expectation that there's still room for growth. So, just because you're not at the peak is not necessarily a bad thing if you're a business owner trying to sell, because the private equity firms have some expectation of a possibility for growth. But then, two, we always tell business owners that it's best to get the bad news out early. And the reason for that is not only because it's just the best use of everyone's time. If there is, call it, like I use that example of customer concentration, it's best to know that early, just to, you're not wasting everyone's time, but also it just becomes a point for negotiation if there are surprises later in a deal process. Inevitably, in every process, there are going to be surprises. So it's best to try and avoid as many as possible, just for both parties.
That's great. I think it's awesome advice. Lamar, really appreciate you being with us today. And if folks in the M&A Unplugged community wanted to reach out to you, how could they get in touch with you?
Sure. So we are at GenCap America, and that's the website, GenCapAmerica.com. You can find all of our contact information there, but my email address is lstanley, as in Lamar, at GenCapAmerica.com. And, if you're looking to ask questions or just want to reach out and talk, feel free to give us a ring.
All right, Lamar, thank you so much. Really appreciate you being with us today and sharing all this information.
Thanks. Really appreciate it.
So, M&A Unplugged community, let me just recap a few things that Lamar talked about. For GenCap, they have specific criteria. They're looking for stable companies. They're looking for the management teams to stick around. They're trying to protect against downside. And that's one flavor of private equity. There are many, many different flavors of private equity. Some others are looking for, rocket growth. It just depends. So it's not a one size fits all. They happen to have their methodology that's worked for them for a very long time. So it's important to talk to advisors to understand, where does your opportunity best fit in the marketplace if you're getting ready to take it out. And Lamar talked about a couple of other things that I think are really critical. We've mentioned them on other podcasts. One, if you're the owner of the business and you are an integral part of that business and you're in an operating position, it's best to really try to delegate those tasks and get yourself out of many of those things before you go to market. One, it will make your life a lot less complicated. And two, it will really increase the marketability and the value of your business. Lamar also talked about client concentration. This comes up a lot. GenCap's benchmark happens to be about 20, maybe 30%. Every private equity group approaches this a little bit differently, and some of it is industry specific, but client concentrations can really come back to bite you. So you want to try to minimize those as much as you can before you get ready to go to market. And then once you are in the market, Lamar was, I think, spot on. Get the bad news out early. There's no hiding from bad news. I promise you, once you get into due diligence, smart buyers are going to find the bad news. So get it out early and figure out if your business really is sellable. And a lot of that can be done well in advance. Well, I hope you enjoyed today's episode. All of the information will be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit our website at sunacquisitions.com, or feel free to reach out to me at drinaldi@sunacquisitions.com. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.